The risk premium is the following. This is really the subject that we spent the last 50 years in finance, but not necessarily with most conclusive results. But the model that we use off and on is to use this measure, what we call beta, times, this is known as the risk premium, or a market, what did I write over here? Market risk premium, meaning that if I were to, for example, hold on a market portfolio for years and years, I might be earning an excess return over, say, treasury bonds or securities. Let me show you one that's where this thing comes from. Again, this is a colleague of mine who, if you were to look, if you were to put $1, this is a crazy, crazy table. But what is, oh no. Yes, what I have to do is, if you were to put $1 in 1802 in stock market, in 2007, it would have been almost 700,000 real dollars. Not bad, huh? If you were to put bonds in the United States, this is almost like 200 years, you would have earned $1,530. So obviously, if you were in stock market, this is what I'm talking about. If it's more volatile, but it also provides a more generous return in future. So in other words, if I'm interested in here as a risk premium because I'm holding equity, so there must be some premium for holding that. There is this sort of rate. And the other thing that you might find it interesting is if you were to look at treasury short-term bills, because they're much lower in return, you get almost $295. That's gold. Gold doesn't really do much. That doesn't provide much for you. Today, it may be going up, but eventually, it's not going to be a great investment. It would all barely, I mean, what it did, it just barely created. And if you were to hold $1 with inflation, it would have been the worst. I mean, gold, yes, protects against inflation, but if you really want to do well in the long run, you should be in a diversified stock portfolio for the long haul. Not necessarily 200, but even this is true for 50 years or so. And the next thing is that I want to do is, let's see, is the following. These are sort of stock market returns. If you were to look at different long term, right? And the real return, meaning that that premium is almost 6.7% for long periods of time. That means if you want to convince people to hold equity, you should provide a premium about 6%. So by definition, we know that when I'm interested in this discount rate for a stock, it should be at least some 5 to 6%. And the sub-periods are slightly different. They're awful. But really, the long period, it seems like around 6 to 7%. Then if I find a measure of beta, then I could find the return required for the equity holders. And that measure, what we use is the beta. This beta, as we were describing, measures the relative volatility to the stock. If it is 1, that means your stock is almost identical to diversified stock portfolio. If it has a 0 beta, meaning that you have really no volatility compared to the market, so therefore you're almost like having a riskless security. So in this case, for example, the beta of this particular company is, let's go back to our story. In this case, we have a beta is almost like 1. That means Dow Chemical, or in this case, the Rome Haas, is really like holding the stock portfolio. Therefore, the required rate of return on that, if I use this model, risk-free rate is about 4.9%. And the market price of risk, this is where you get into the difficulties or discussions. And this is the Goldman Sachs use a lower estimate. And I use typically about 7% in the long haul. That's sort of why, well, we're all statisticians. And investment bankers tend to have a little bias because they are representing the sell side. So they like to use a lower estimate to make the value higher. Right? Keep that. There is, listen, I know.
The buy side also.
Ante is saying that this is maybe silly, but unfortunately, we're a statistician because these are not observable variables. So as a result, all we have is the past data. This is why you may get into some agreements, disagreements when you use discounted cash flow method, because you need to estimate this cost of capital. Now you realize why people like to use comparables, because you say, this guy is selling at the same price. I don't know why they're paying for it, but I want to get the same money. Here we try to understand why. But that requires additional assumptions. So in other words, to make the long story short, we have also the other notion. Is everyone familiar with the weighted average cost of capital? What it is really the following. In a corporation, in finance, I see the corporations as such, which is very cavalier. Like yesterday, we were discussing the Mr. Clarkson company. For me, a corporation is, this is the assets generating EBIT, and I support this with debt and equity. That's how I finance it. At the margin, if I satisfy the bondholders and equity holders, that means if I go beyond that return, I'm better off. So the minimum rate I should provide must be equal to, this is the required rate of return for the equity holders. We don't know what it is because we have to figure it out. We have to estimate. You cannot observe that unless you ask everyone. And that model, or this model that we have, is this sort of scientific, statistical model to get an idea about this variable that we cannot possibly observe. But it's a sort of fiction. Right? Just like even the theory of relativity is a fiction. I mean, Einstein's theory, you know, it's fiction. I mean, it explains sort of heavenly bodies. But when you move into the quantum mechanics level, it falls apart. It has no predictive power. That's what physicists are trying to do for the last 90 years. Try to combine the theory of relativity, the quantum level, and the Einstein level. But for certain purposes, it works well. It describes how a solar system works and all that. So in that sense, we can say that, well, this model may not be perfect, but it gives us some indication. So over here, this is the return for the equity holders, and this is the amount. So the debt plus equity is equal to the enterprise value. I would satisfy the equity holders by the proportion of their contribution to my capital structure. And plus, this is, of course, an after-tax rate of return. And then I'm going to, because interest payments are tax deductible. So this is after tax, and this is the proportion of debt in my capital structure. That means on a per unit basis, if I generate a return for my capital suppliers, I'm all right. If I generate more than that, what's going to happen? Your shareholders will be happy. That's going to increase value. This is the minimum that you would return. Therefore, in this model, if I put weighted average cost of capital here, that would be the discount rate that I should bring future cash flows back to today. And these are, again, I cannot observe, but that's going to be sort of the cash flows, expected cash flows, just like yesterday we had those projections. That's going to be the projections. We think what's going to happen in the future. So now valuation, I don't want to give you this feeling, it's not a science fiction, it's not a sort of an imagination, but we try to quantify things that are really impossible or it's never going to be observed until we get there. Right now it's in future, but we quantify, we sort of make it more have a methodological approach to the issue. And then we can look at some sensitivity analysis.